Dear students, this is just a discussion of that last part of the basic principles of share capital that we couldn't quite finish in our first class. So the idea is just to finish that discussion. So I'm just recording it now because we didn't have time for this in class today, and then I will post it on Blackboard. In any case, the good thing that we're discussing this now is that Mrs. Moore has done question 2 of the question bank with you this morning and this afternoon. So many of these issues have actually been addressed to a certain extent. So now we just want to go and look at the if you want to call it the theory behind it. So let us maybe just go back to that first page. um, we've already mentioned this toward the end of today's class number 2, that if your preference share capital, if they are redeemable, and it's redeemable at the option of the company, as was the case in that question 2, that means your redeemable preference share capital is seen as part of your equity. But like we alluded to last week, when there is a fixed date already on the date of the issue of those redeemable preference shares, it means that it is actually a liability for the company, and then we will rather disclose it as a long-term liability, because the fact that we owe the money and that it is definitely going to be repaid means that the essence of the transaction is that it is a long-term liability or a non-current liability. The same if the redemption can take place at the option of the shareholders. That means, like we said last week, at any general meeting, annual general meeting, or any other special general meeting, they can decide that the company must repay that capital on the preference shares, let's say at a certain date at the end of the month or at the end of the year or whatever. But if it's at the option of the company, then the company may decide never to redeem it. So then it is seen as part of your equity. Also, if the shareholders have the option to decide when the redemption can take place, then it shouldn't be seen as equity. It should be seen as a non-current liability. But as we also mentioned last week, in financial accounting too, we are not going to encounter any situation where you have to regard your preference share capital as a long-term or non-current liability. In all our cases, it will be seen as equity, and that is the reason why that question specifically mentioned that the redemption is at the option of the company. Now let us just go to the other two matters that we haven't been able to address. You saw that when Mrs. Moore discussed question 2 with you, they mentioned that both the ordinary shares and the preference shares, uh, they do not have a par value, so they are non-par value shares. So maybe let us just discuss that scenario. Mrs. Moore has already mentioned in the class when she discussed question 2 that the par value is just a nominal value that is associated with the shares, but it doesn't really mean anything. It doesn't have any specific connotation, except that it is just sort of uh, it's just attached to the shares. Now let us maybe talk about the history of this, and maybe that will become clearer. In our previous, there are many documents and proclamations that we have to take into account. There are the International Financial Reporting Standards, but there are also the Companies Act or Companies Acts in various countries. So we know that our International Financial Reporting Standards allow the issue of par value shares and the issue of non-par value shares. Our previous two Companies Acts, the one of 1929 and the one of 1973, also allowed the issue of par value as well as the issue of non-par value shares. But when the discussions took place about the latest Companies Act in South Africa, the one of 2008, it was felt by all the contributors to the Act that a par value because it is really meaningless, it can actually be confusing. So it can be confusing if you have, let's say, 1 million ordinary shares of 1 rands each, and that of 1 rands each means it has a par value. So if you are authorized to issue 1 million par value shares at 1 rands each, why is a company then allowed to issue those shares at a premium? In other words, they can issue at 1 rand 50 or 2 rands or 3 rands or whatever they feel is appropriate. They can issue it at a discount, so they can issue those 1 rand shares at 75 cents or at 50 cents, or they can issue them at 1 rands, but that will in most cases just be a coincidence. Also, where it may become confusing is that the par value has got no correlation with the market value. So your 1 rand par value shares might be trading at 5 rand or at 15 rand or at 20 rands in the market. Not only listed shares, because listed shares, there's an active market, obviously, whether it be the JSE or LSE or NYSE or the NASDAQ or any securities exchange. There is an active market. But even in the case of private companies where there's not an active market, when it comes to the trading of those shares, it will be determined by normal market conditions. In other words, what economics tells you, it's really going to be a matter of supply and demand. On the one hand, supply and demand, is it in demand? What is the supply? And then also the size or the market capitalization, the so-called size of the chocolate cake, the market capitalization of that company at that point in time. So really you can see the par value has got no link or no correlation with either the market value or the share issue price. So because it can be a confusing figure which really doesn't mean anything, the 2008 Companies Act determined that only non-par value shares may be issued as from the date when that act came into effect. The act in the regulations to the act, it actually goes further, and they say that if the company had previously, before the 2008 Companies Act came into effect, if they had issued prior to that par value shares, then they are allowed to leave the par value shares as issued. So in the market, they don't have to withdraw it. That is why we still sometimes today get companies with a share capital account and a share premium account, but that is now beyond our discussion. Um, but if the company wants to issue, if they had previously issued par value shares and they've got unauthorized par value shares and they intend to issue new shares, before they are allowed to issue the new shares, they have to convert it in their MOI or Memorandum of Incorporation. They have to convert that to non-par value shares before they are allowed to issue those shares. Okay, so that is the matter of par value versus non-par value. Like we say, older companies who issued those shares prior to the 2000 Act being coming into effect, which I think was the 1st of April 2011 only. It was quite a few years after the Act was promulgated. But anyway, so we now see we can't issue non-par par value shares anymore, only non-par value shares. Then when it comes to capital maintenance clauses in the Companies Act, now we saw when Mrs. Moore did question 2 with you earlier today, before the redemption could take place, the redemption of the redeemable preference shares, a finance plan was drawn up first. So there was a mechanism in place to make sure that the company does not bankrupt itself during the course of that redemption. So there are many capital maintenance clauses in the Companies Act. The one that is of particular interest to us while we are discussing share capital and especially redemption of share capital and dividends and share buybacks, uh, the one clause, I think the clause is actually mentioned there in question number 2, is that a company is not allowed to make any distribution to the shareholders unless the company can pass the solvency test and the liquidity test, right? So, what is meant by any distribution to shareholders? It means they cannot declare a dividend unless the company passes the solvency and the liquidity test. They cannot do a share buyback of ordinary shares unless the company complies with it or is in compliance with the test, the solvency and the liquidity test. They cannot do a redemption of preference shares if the company does not pass the solvency and the liquidity test. Right. So no distribution, whether it's a buyback of ordinary shares, whether it's a redemption of preference shares, even a dividend. A dividend may not be declared if the company will not pass the solvency and liquidity tests. So, what are those tests? They were actually illustrated in that question number 2 that Mrs. Moore has done earlier today. The solvency test simply means that the company will not be technically insolvent after the distribution has taken place. So, what does that imply or what does that mean? It means after the distribution has taken place, the company's assets must still exceed its total liability. So the company must still be technically solvent. The company must also pass the liquidity test. What does that mean? It means that the company, after the distribution, must still be able to pay their day-to-day running expenses. In other words, their salaries and their wages at the end of the month, and they must still be able to pay their creditors. So now it's a shorter term view than than the solvency test. So the solvency test looks at your assets, your total assets versus your total liabilities over a long term. Whereas the liquidity test on the shorter term, it looks at your current your cash flow situation in effect that you can service your debts at the end of the month and that you can pay your running expenses as and when they become due. That is one of the reasons why we had that financing plan. A company, for instance, cannot do a redemption of preference shares or any other distribution unless it has the cash. And by the way, those two tests, it must actually be minuted in the directors' meetings minutes. It must be minuted that before the distribution has been approved, that both of those tests were considered and that it is clear that the company will pass both of that test. So it must be minuted it must have been discussed in the directors' meetings and minuted as such. So in this case, the case of question number 2 and most of the questions that we are going to be discussing, the company only passes those two tests once it has a financing plan in place. So if the company already is so cash flush, they have so much cash on hand that they can do a distribution, a redemption of preference shares or a share buyback without obtaining additional funding, then they can simply go ahead. But more often than not, you will find that the company does not have sufficient cash to do a redemption, even though they want to do the redemption, or they might not have sufficient cash to do a share buyback. Then, before they can do those actions, they have to have a financing plan in place. And that is why we get to that situation where we first see how much money, how much funds are required to do the redemption of the preference shares or to do the buyback of ordinary shares. And then, ladies and gentlemen, once we know how much money is required, then we go and see where is the money going to come from. Our first source might be our cash resources as a company itself, but then if that is not sufficient, then we might have to look at other sources of funding, such as a long-term loan, or like in that question 2, where they issued debentures being loan instruments, or they could issue other shares, ordinary shares, to fund that redemption of premium, uh, uh, the redemption of the redeemable preference shares. Okay, ladies and gents. So now we've completed that discussion in that document that we started with a week ago. Thank you very much.